Good afternoon. Welcome to everyone. My name is Brian Gigani. I'm a partner in the DC Metro office, and our topic today is audit readiness and preparation. Joining me today is Allison Parsons. She'll be leading off, talking about the key topic, which is audit readiness and preparation. After that, I'll follow with an update on ASC 842, the new lease standard. And rounding out the session will be Conrad Schweitzer, talking about an update on uniform guidance and especially COVID-19 funding. Both Allison and Conrad are out of our DC office as well. A few things before we get started. First of all, you'll be in listening mode for today, and this session is being recorded. You have an opportunity to submit questions by typing your questions in the questions panel on the control panel. You'll also be asked to submit your individual responses through the chat. If there's any connection issues, please contact the IT help desk, and please complete the electronic course evaluation that we launch at the conclusion of the webinar. A link will also be sent in a follow-up email tomorrow. With that, we're going to get just a little bit of time, and then we'll go ahead and get started. Okay. The question is, will everyone get a view of the recording? That answer is yes. So with that, Allison, you'd like to start?
Sure. Thank you, Brian. And thanks for taking the time to join us for today's webinar. I'm going to spend a little bit of time talking about how to prepare your nonprofit organization to be audit ready. So whether this is your first time your organization is being audited, or if you've been through the audit process for many years now, regardless, preparing for an audit might feel pretty overwhelming. I wanted to spend some time to give you some tips and tricks to help make the process run more smoothly and therefore lead to a more efficient audit. So how can you ensure your organization is audit ready? The key is a lot of upfront planning. Planning is the most important phase of the audit, and it really sets the tone for how the rest of the audit process will go. Planning is the phase where the auditors will gather all the information from you, the client, obtain and update the understanding of policies and processes, perform inquiries with management, finance, and operations personnel, assess the level of risk of material misstatement within your organization's financial statements, and also design the nature and extent of further audit procedures. So here are some ways to make the process run more smoothly. The first is to gather all of your organizational documents and significant contracts and agreements into one central location. Your auditor's requests are often available throughout the year, so you don't need to wait until year end to pull it all together for them. The auditor, whether it's a new audit or a recurring audit, is going to ask for copies of what we call the perm file docs. These include things such as your articles of organization, your bylaws, any significant contracts, including vendor or pledge agreements, any debt agreements, leases, retirement plan documents, and things like your board minutes throughout the year. If it's a recurring audit, most likely your auditor will already have copies of these documents from the prior year, but you will need to provide them with any updates, amendments, or modifications to these agreements. So start thinking about those that may have changed during the year and gathering them together now. The earlier you can provide these documents to your auditor, the better off you'll be. The next item is to document your key financial statement processes and policies. We as the auditors are required to gain an understanding of your organization's processes and controls surrounding each of your major transaction cycles. And we perform walkthroughs over the key controls on an annual basis. So before the auditors even come on site, start thinking about if your organization has documented what the internal control processes are, whether it be through the use of flowcharts, narratives, or written policies and procedures manuals. If you don't already have something like that in place, I would suggest taking the time to pull that information together for your auditors now. It will definitely save time during the planning phase of field work, rather than having to sit down and come up with those narratives together. Remember to consider controls and policies over your information technology systems that support your accounting records. IT plays such an integral role in ensuring the reliability of your financial information. And in today's environment, identifying and assessing IT and cybersecurity risks is really an important part of the audit process. The third thing is compile a list of any related parties, affiliated entities, or other organizations under common control. In addition to just compiling that list, also be sure that you're clearly documenting the relationship your organization has with each related party, as well as providing a list of all the transactions that occurred with that entity during the year. If there are any related agreements between the parties, such as lease agreements or management service agreements, be sure to provide your auditor with copies of those as well. Transactions with related parties do require financial statement disclosure, so it is something they will need as part of the audit process. The fourth item is review your accounting records to ensure that reconciliations are available for all of your balance sheet accounts. Hopefully your organization is reconciling its accounts receivable, accounts payable, fixed assets, and bank accounts monthly as part of your normal monthly close process. But remember, it's also important to ensure that you're looking at all of your accounts, even those that are used less frequently, and adjusting them as necessary. Accruals and year-end cutoff is an important part of the annual close process, so be sure you're taking a close look at that. Also, if you're not already performing a variance analysis where you're comparing your current year to prior year or your current year to your annual budget, do so now and make sure that you're able to explain any large or unusual variances. I can guarantee that this is something the auditor is going to do. So you may as well get a jump on making sure you're prepared to answer any of those types of variance questions when the auditor asks them. The fifth item is ensure that the transactional data from the period under audit is organized and available for testing. This includes proof of expenses, such as vendor invoices, proof of sales and cash receipts documentation, support for contributions and payroll records. If you know that you're missing any transactional data for a period of time, start requesting copies of that from your vendors and donors now, rather than waiting for the auditor to request the copies, which could cause delays or holdups in the audit process. Another helpful thing to consider is if your organization does use any software for the approval and processing of expenses or expense reimbursements, consider granting your auditors view-only access to those sites to help facilitate some of the back and forth over needing to pull vendor invoices. If you want to move to the next slide. Communication is one of the key elements to a successful audit. What's really critically important is being mindful of the fact that communication with the audit team should not just start when the audit team is ready to come on site for fieldwork. We want to think about a number of items throughout the year, including what changed from last year's audit. Have there been any changes in your organization or in the community at large that could impact the financial statement audit, or how you receive donations, or the way in which you spend them? Were there any changes in the accounting system during the year that changed your chart of accounts? Have you received a grant or a contribution this year that was unique or contained language you haven't seen before that could present a barrier to recognizing that revenue? These all could be indicators of changes in accounting treatment that the auditors would want to be aware of, so that you can make sure that you're reporting them properly in your financial statements before the auditors come on site for testing. Remember, your auditors are there as a resource for you, so use them, run things past them, get their buy-in early on how you're reporting a transaction. They may suggest revisions to your proposed treatment, or may give you other factors to consider that would require you to possibly go back and talk to your board or other members of management. So the earlier on you can have those discussions, the better off you'll be. So we talked a little bit about how important it is to communicate with the auditors prior to fieldwork. So now say that the fieldwork phase is here, and it means that your auditors could be coming on site, or there's a good chance that you're still doing a virtual or a remote audit. While the audit's in progress, we highly recommend having regular weekly meetings with management in order to keep everyone on task, to walk through any open items that are outstanding with them, and to address any questions that are coming up during the audit. It also might be helpful to continue to have these touch point meetings after the fieldwork phase of the audit and through the report issuance, maybe not as frequently as during the fieldwork phase, but just to ensure that everyone's aware of the timing and any questions or issues that may arise as the audit progresses through the review process. These regular communications will hopefully alleviate any unwarranted stress and prevent any surprises that come out of the review process. In addition, one of the things that we highly recommend is having an exit meeting with your auditors at the conclusion of the audit to debrief while everything is still fresh on your mind. Spending the time to do this will help you when it comes to planning for next year's audit. You want to think about what didn't go well. What hurdles did you have when it came to timing? Did you have any conflicts with any members of the engagement team? Be upfront with your auditors and give them this feedback. Another really critical factor to ensuring a smooth audit is setting expectations with the client and with those charged with governance, such as the audit committee, finance committee, or the board of directors. It's important to make sure that the team understands the client's deadlines, whether they're regulatory, such as a federal audit clearinghouse filing deadline, whether the deadline is stipulated by a debt agreement, or whether the board likes to have the audit complete in time for a board meeting that's going to be held on a specific date. Having that final deliverable deadline established will allow the auditors to back into the timeline throughout the entire audit process as to when PDCs will be sent and received, when selections will be made, when fieldwork will occur, and the timing of the review process. Having a timeline for the entire process helps keep everyone accountable and on target. If you do have those regular or weekly check-in meetings during the audit, that would be a good time to discuss if the audit timeline is still on track and if you're still on target to meet the established deadlines. Next slide, please. So, in looking at last year's audit, the best way to make the audit more efficient this year is to look at what happened last year. Looking at last year will shed some light on some of the pitfalls that you're trying to avoid from the prior year. You want to learn from last year's audit. This includes reviewing all of the oral or written communications that you received from your auditor about any control deficiencies or material weaknesses identified during the audit. You'll want to make sure that your organization has implemented policies or made any necessary changes in their control structure in order to address these findings so that they aren't recurring findings in the current year. Additionally, you'll want to review the audit adjustments from the prior year to ensure that management has corrected any breakdowns in processes that resulted in those material adjustments to your prior year financial statements. You'll also want to be sure to take a look at the past adjustments from prior year. Those are those entries that the auditor identified that weren't material to the financial statements as a whole, but they were items that were not properly reported. Another tip is to keep abreast of new accounting standards. It's really important to stay informed about any changes to legislation, accounting pronouncements, or other compliance updates that will impact your organization's financial statements. While it's often assumed that it's only the auditor's job to keep up to date with these changes, management is responsible for and should have a working knowledge of their requirements in order to be able to assess the impact the standard will have on your organization. Keeping up with the changes will also require you to ensure that the accounting system and the records are set up to produce the required information that the auditors will need in order to audit your organization's adoption of the standard. That could mean creating new accounts in your chart of accounts, or even identifying other tools or programs that your organization might need, such as with the new LEASE standard that Brian will talk about shortly. It will assist you also in identifying if there's any additional training needs for your staff in order to properly implement the standard and ensure that they know how to record transactions going forward. There are a number of ways to stay up to date on the new standards, including attending webinars and CPE, such as those offered by Citron Cooperman or your other service providers. Also, the AICPA and the various state societies offer newsletters and updates to help educate and inform on any new and upcoming pronouncements. Next slide, please. So self-review everything. This may sound obvious, but double check to ensure that your reconciliations and your schedules that you're providing to the auditor tie back to the trial balance. I can't tell you how many times we encounter this, and it really does cause considerable delays. As the audit team has to kick schedules back to management, they have to research and look into what's causing the difference. All of that just leads to unnecessary delays and inefficiencies in the whole audit process. So I hope I've been able to give you a few tips and tricks to help your organization feel more prepared to start the annual audit process. For well-prepared organizations, the audit process can be a helpful tool in assessing the financial health rather than just an exhaustive exercise in pulling data. Communication with your auditors has always been important, but given the challenges with the pandemic that we've experienced over the past 2 years, it's made open collaboration and flexibility between nonprofits and their auditors even more critical than ever. So with that, let me kick it over to Brian to discuss the new LEASE standard.
Thank you, Allison. Those are very good comments. And I'd like to build on those comments a little bit, talking about ASC S42, the new LEASE standard. Please advance the slide. This new accounting pronouncement is effective for years after 12/15/2021. So for calendar year organizations, that'll be your upcoming 2022 audit. And for fiscal year organizations, it's going to be like a lot of June 30th audits. It'll be June 30th, 2023. And I know there's the common theme would be, okay, I know it's issue, I know it's down the road, but let me put it off. I have so much to do. But really, there's a lot of considerations that we need to do to think about this. Number one is it is a change in accounting method, which means that your financial statements, for the ones this is applicable to, your financial statements will change. There'll be disclosures, and that your year-end financial statements may not be the same as last year, or probably will not be the same as last year. So you need to think about that, because that can affect both your internal reporting and your external reporting. The complexity of this pronouncement will depend on the number of leases that you have. I'm going to say most organizations have at least one lease right now, which would be their office lease. And I know that's changing because of COVID and people working remotely, but working with that basic thing, we have that office lease, and usually that office lease is quite a substantial number. And as I'll go into in a few minutes, figuring out what that liability is can be a difficult process. But we also can't just focus on the office lease itself. There could be equipment leases as well. Again, most organizations have a copier lease. Some organizations have automobile leases and other equipment type leases, and we have to look at those leases as well. The standards are pretty much the same in terms of what's material or not, but again, it's something that the organization has to look at to make sure it encompasses all leases. And then we have to consider how this is affecting your budget. Depending on the type of lease, as we'll go into a second, is it going to change how your P&L looks, how your budget looks in terms of line items in there? Overall, I'm hoping it does not have a big significant change, but there is that possibility. And so you want to make sure your budget and internal reporting is aligned with your external reporting. The bigger one, which is the effect on loans and other covenants, because what happens with this standard is you're going to require, possibly a large liability on your balance sheet, and a larger, an equally large asset on your asset side as well. And is your bank prepared for that? Is your organization prepared for that? I had lunch just the other morning with a banker, and they just, discussed with me how they were dismayed that most of their nonprofits who do have loans have not come to them about whether a loan covenant change is required, or do the planning type of stuff. And they felt that they've reached out, to their clients as well. So again, think about that. And it's not an easy process, to have an amendment to your lease or your loan covenants from that standpoint. So you have to think about that. And again, the internal versus the external reporting, this applies to GAAP-based financial statements. It does not apply to your 990, so there may be differences there. And then, so again, just be prepared, align your reporting internally and externally, and now's the time to look at that. Please advance the slide. So as I mentioned before, the technical term for this is ASU 2016-02 leases. It's also going under topic 842 for leases. It's effective for fiscal years ending after 12/15/2021. And as I mentioned before, that means it'll be effective for your December 31st, 2021 year ends. And then for fiscal years, it'll be into 2023, depending on your fiscal year. And I know many of you have probably just finished your 2021 audit and gotten through that process, and you're saying, oh, I don't want to deal with the audit for another year. And I recognize that, but again, now's a really good time to start with that, because depending again on the complexity of leases and how many leases that you have, there's a lot of factors of consideration that must go into it. Again, under the standard, what happens is if a lease has a term greater than 12 months, it must be recognized on the statement of financial position through a right of use asset and a lease liability. And again, the background to this is many organizations could have a very strong balance sheet, but they could have, a 10 or 15-year lease, and that liability was never on the balance sheet before. And what the purpose of this standard is to get that liability on there and to recognize that right of use asset. If your lease is less than 12 months, you can make an election not to recognize a lease on the statement of financial state position. Instead, you can just record it as a lease expense, recorded on a straight line basis over the period of lease. But you have to be careful with that too, because some leases would be considered, you'd have a contract that may be considered an embedded lease. I'll use as a simplistic example, your copier lease. When you rent a copier, your copier lease has both the lease and it also may have a maintenance or supply portion to it. Under the standard, you're looking just at the lease portion, not at the maintenance portion, and not at any type of supply portion that's included in there. There are some practical expedients, which we'll talk about in a few minutes. But again, you have to look at your leases, and you may look at other contracts that are not labeled as a lease, but may have a lease component to it as well. Another example that probably applies to a few nonprofits, depending what you do, is that if you have a construction contract and as part of that construction contract, you're leasing equipment. I know that's probably not your run-of-the-mill nonprofit. That may be the one that's a nonprofit dealing with, low-income housing or so forth. But you really need to look at those contracts to see if there is a lease portion to it under the embedded lease rules. The ASU defines a lease as a right to control the use of an asset for a period in exchange for consideration. Again, this can come in various forms, such as property, plant, and equipment. It could be any number of things from that standpoint. Next slide, please. So, as I mentioned before, a contract can be either lease in its entirety or contain a lease component, and that would be the embedded lease portion of the standards. The contract does, if it is a contract, the lease must be separated out unless it meets one of the practical expedients. So under ASC 842, you need to allocate out of the total payment or consideration just the lease portion and separate that from the non-lease portion. Okay, and as I mentioned before, if it's not material and it makes a practical expedient, you can ignore the non-lease portion if you're a nonprofit, a non-public business, and even a nonprofit that issues bond. That was a key consideration that has been done recently, and just treat it as a single component. Now, you may or may not want to do that, because if you do treat it as a single component, then obviously the lease liability will be higher. And so that's going to be decided on a case-by-case basis for the organization. You have to make it for all items in that class of assets, but again, it's made on a organization by organization basis. Again, the key portion here is that the focus is on control. And also the right to obtain substantially all the economic benefits of the asset, and the right to do directed use of the asset, and would include the lease itself and any reasonable extension to that lease. A very common example may be you sign a 10-year office lease with 2 5-year renewals on that. In determining the period itself, you have to look at it. Is this a 10-year period of time that I'm working with, or is this a 15 or 20-year period of time? And again, that's based on a case-by-case basis, a lease-by-lease basis, depending on where your organization is and what's the use of that lease property. So the overall calculation is you take those lease payments and you use a present value factor to bring back to come up with an estimated liability for that situation. Now that rate factor can be based on the a borrowing rate of the organization, or what the AICPA has come up with, the FASB has come up with, is a practical expedient that you can use a risk-free rate, such as a US Treasury rate. And for smaller organizations, it really probably will save a lot of headaches and aggravation to use that risk-free rate rather than try to determine what your internal borrowing rate is. Because in many cases, you're not borrowing money, and to come up with that rate based on a bunch of assumptions and factor, it may be, like I said, easier just to use that US Treasury or others or similar risk-free rate. Now, the problem with that is that the US Treasury rate is lower than most borrowing rates. So that's going to create a higher liability and a higher asset. And again, each organization has to look at that and say, is that the right, is that right for my organization or not? Is it going to put a liability too high or an asset too high? And does that affect my other factors, such as a loan covenant? If you don't have a loan covenant, then it may be an easy decision. And we're thinking that most smaller organizations, and when I say smaller organizations, I'm talking anywhere from $20 million and less, it may be better. If it's a larger organization, again, there may be more study involved with that. And again, it gets into the complexity and the number of leases that you have. If you have one or two leases, I think the calculations can be very manageable. If you have a lot of leases, there's specific software out there that will help you both in the calculation of the lease liability and the related disclosures under 842. Next slide, please. So in terms of ASC 842, it breaks down the leases into two categories. One would be a finance lease and the other would be an operating lease. And as the table shows, it does a quick comparison as to the similarities and the differences between the different types of leases on the main financial statements, would be your statement of financial position, your statement of activities, and your statement of cash flows. Under both, you'd be recording that right of use asset and lease liability, and that would be virtually the same. And again, if I didn't mention it before, but what happens is you recognize this asset and you depreciate that, and that depreciation expense would go through the P&L as an expense item. On the liability side, there would be a principal and interest portion. Obviously, the principal portion would reduce that liability as the lease payments are made, and the interest portion would go to the P&L as well. And in theory, the depreciation and the interest should be roughly the equivalent of that lease payment. And so in many cases, the P&L effect shouldn't be nominal. But depending on the lease itself and the number of rent holidays or lease incentives, it could be significant different items. So again, that's why planning for that now, looking at it, modeling it from how that's going to affect things, and be able to go through different models or projections to see how this affects your financial statement, so that when the audit comes up, you're not dealing with it as a last minute item, but again, you're dealing it with more from a conclusion basis, and you've had the time to think through things. Again, I mentioned on the statement of activities, you'd have an amortization expense and interest, and on the operating lease, you would just have the lease payment as an expense, again, as that line item. But again, it's on a straight line basis. And again, that goes into certain leases where there could be rent holidays and lease incentives, as I mentioned before. If you get the first 6 months rent free, most people would recognize that's 6 months right now and just would not record an expense. But under the new standard, you'd have to record a portion of that lease incentive or rent holiday would have to be allocated over the entire term of the lease, and that could increase your expense for the year. On the statement of cash flows, you would report the principal payments or the equivalent of the principal payments as a financing activities, and the interest would go under operating activities. And under the operating lease, it would all go under operating activities. So that's a lot to absorb and understand. Again, if you haven't looked at it now, I would say definitely now's the time to look at it, get a great understanding what's going on, model it, plan for it so that, again, it's not a surprise that next year's audit, and kind of going back to what Allison said about setting timelines and deadlines, this is something that can just, blow up an audit at the end, and that's what you don't want to do. Again, you can use your account, I would contact your accountants now, auditors, say, we want to deal with this, let's get it on the schedule and talk about it if you haven't already done so. If they're not available, then I'm sure you can find someone that could do this for you on a consulting basis, and look at, how this affects your organization. Again, both internally and externally in terms of your reporting. And again, just from my practical experience, coming up with surprises to the board at the end of the year is the worst time to come up with a surprise. We've had to deal with that under COVID, and I'd say the boards have been very flexible, but if this is something that's manageable and something we can plan for, we should do that now. Okay. Thank you. That concludes my comments. Turn it over to Conrad.
Great. Thank you, Brian. Good afternoon, everyone. I'll be providing a brief update from the world of uniform guidance. And the key reason we want to cover this is because there have been several new federal programs that have been created in the last couple of years as a response to the pandemic. And as a result, not-for-profit organizations receiving this support in the form of grants or other assistance may now find themselves with new reporting or even audit requirements for the first time. So to kick it off, I want to start high level and just talk about what a uniform guidance is. Next slide, please. If you're not already familiar, a uniform guidance, or UG, audit applies if an entity has expended more than $750,000 of federal funds during their fiscal year. And the key word here is expended. This audit threshold is not based on what you have received or drawn down. It's based on what was actually spent. And if a UG audit applies, it subjects the organization to a compliance audit over federal awards, separate from a financial statement audit that you might already be receiving. And the UG audit is all about controls and compliance. The government has specific rules about the internal control frameworks that must be implemented and maintained, and compliance rules dictating not only what the funds can be used for, but also how to spend them in the form of procurement rules, for example. There are two different types of these audits: program-specific audits and single audits. A program-specific audit is a compliance audit for an individual federal program. A single audit is also a compliance audit, but it also includes an audit of the overall financial statements and federal programs. So it's a financial statement audit and an additional compliance audit in one package. Historically, program-specific audits have been relatively rare, as one of the requirements to use them is that an organization only have a single federal program or cluster, as long as it's not a research or development cluster. So as soon as you have two programs, a program-specific audit is no longer an option. However, with many nonprofit organizations recently receiving federal funding for the first time under one of the new relief programs, there's been a notable uptick in program-specific audits being performed. So with that high-level background, let's talk about the current state of affairs. Next slide, please. Next slide, please. In May, the Office of Management and Budget released the 2022 compliance supplement. And aside from individual grant agreements, this document is a key source of information on the requirements for a whole host of federal programs. The compliance supplement is issued annually by the OMB and is used by both recipient organizations and auditors in preparing for a uniform guidance audit. It has a wealth of information and really is a very valuable guide. This year, the supplement stands on its own. The last few years, the annual supplement was followed up by additional addendums as a result of the rapidly evolving relief programs and the related guidance that needed to be issued for those. So that definitely complicated matters, and there were multiple documents needed to use for reference. So this year, it's just one document, which is generally how it's been prior to the pandemic. The compliance supplement has 8 parts, but I just want to focus on part 2, which is the matrix of compliance requirements. And in that section, there is a list of every program that is covered by the supplement and a column for each of the 12 compliance requirements. And the government tells us which of those requirements generally are applicable for each program. So this is a key first step in evaluating which program requirements might apply to your award. Part 2 also shows us which programs have been added into the compliance supplement for the first time. And that's what I wanted to highlight here, as some of you might have these programs. The good news is that they are now part of the compliance supplement, which should make the work of being in compliance a little easier, since now there's guidance that you can use to determine the applicable requirements. So you can see the list here, and we'll touch on the shuttered venue operators program a little later on. Next slide, please. The new compliance supplement also now incorporates several programs that were included in the separate addendums that were issued after the release of the 2021 supplement. So those programs are listed here just as an informational overview. So what this means is that rather than being separate addendums to the supplement, they are now included in the annual supplement, which again just simplifies things a great deal. You can see most of these are various COVID-related relief programs. Next slide, please. One of the bigger relief programs was the shuttered venue operators program. These grants provided additional funding for hard-hit entities such as line venue operators or promoters, theatrical or production companies, live performing arts organizations, museums, and movie theater operators. This program began in April 2021 and provided total funding of over $16 billion. For the initial round of funding, entities had to show a 25% decrease in revenues quarter over quarter, and to be eligible for an additional round, they had to show a decrease of revenues of 70%. The first round of funds needed to be spent within 1 year, and if additional funding was received, it needed to be used within 18 months. The 2021 supplement did not include the SVOG program, and the 2022 supplement now does include it. And the supplement tells us that the 2022 supplement can be used as a guide for 2021 audits. But since the 2022 supplement is not intended to be the gospel for 2021 audits, the supplement tells us that the part 7 of the 2021 compliance supplement should be used as the primary source for evaluating the compliance requirements applicable to the SVOG. So essentially what this is saying is you can't use the 2022 compliance supplement to determine all the applicable compliance requirements. You really still need to use part 7 of the 2021 guide. Next slide, please. We also wanted to mention ARPA funds, which is the American Rescue Plan Act from March 2021. These funds made their way through a whole host of different programs and causes. And what we wanted to point out here is that these funds generally are not separate programs with separate CFDA numbers, which is how the government labels and categorizes its federal programs. Oftentimes, these funds were dispersed outside of the traditional granting process. So organizations might not have kept track of underlying or awarding documents and might not be aware that these funds do fall under uniform guidance. So the key here is to have a process in place to identify the source of any funding received and to be able to apply any applicable compliance requirements. Next slide, please. Lastly, one other change that came out with the 2022 compliance supplement was an upcoming change to the submission process for single audits and program-specific audits. These audits are due to be uploaded to the Federal Audit Clearinghouse, or FAC, the earlier of 30 days after the financial statement issuance or within 9 months of your year end. So whichever comes first. The FAC's provider for uploads has been Census, but effective October 1st of this year, they are transitioning to the General Services Administration, GSA. So what that means is audits with fiscal periods in 2021 need to be uploaded prior to the transition, so prior to October 1st. Audits with fiscal periods in 2022 cannot upload until after the transition. This is not a problem when it comes to the within 9 months of year-end filing requirement, but it can interfere with the within 30 days of audit issuance requirement. Therefore, that 30-day requirement is automatically waived for fiscal periods 2022 audits, so that the submissions can wait until they can be made beginning October 1st, 2022. And that wraps up our uniform guidance update. So now we'd like to open the floor to any questions.
Are there any questions? Well, if not, just kind of a quick poll maybe before we close it out. How many organizations have considered ASC 842? Can you just maybe in the chat put a yes or no in that situation, just to see what's out there from that standpoint? I like one answer from, I think it's Janine. She said no, but will now. But it looks like a lot of you have considered that, which is really good. That's very positive to see from that standpoint. And the ones that haven't, again, now's a good time to do that from that standpoint. And I think this question, there'll be a copy of the slides will be made available. I believe they'll be on our website, but when the evaluation goes out tomorrow, we'll have additional information about that. So quite a few yeses, several no's, that type of situation.
Brian, I am seeing one question about remote audits. It's asking about any suggestions or tips from the auditor's perspective on things that need to be considered for a remote audit. And that's a great question. Since the pandemic began in 2020, it's forced many of us to switch to remote audits. And we learned with the use of effective technology and regular communication, that was really key to that shift. But now that we're into 2022, some of us are moving back to a more hybrid model. So, you definitely want to be upfront with your auditors and make sure to communicate to them what type of audit you're going to want. If you want them on site for part or all of the audit, if you still want to do a virtual audit, which is, surprisingly, I found most of my clients do still want to do that. Just be sure to communicate upfront with your auditors. If you want them on site, I would say that coordination of your schedules is key. You're going to want to make sure that you have adequate space for the team, and that you and your critical team members are going to be on site when the auditors are there to answer their questions. If you're still wanting to do a virtual audit, it's going to be really important to make sure that you are still planning to make yourself accessible while the time is scheduled that the auditors are going to be performing their work. It's so easy to fall into that out of sight, out of mind mindset, not intentionally, but just because they aren't there in the office next to you, hitting you up with questions. So if your auditors aren't reaching out to you, reach out to them, ask what they need, ask if they have any questions, ask if you can set up a half-hour call at the end of the day just to touch base on things. So those would be my tips for remote audits.
So following up on that, Allison, there was a question is, do the auditors, are they required to give an organization the option for the office or virtual? I really can't answer that because I think that goes firm to firm. I know our firm does. I know during the highest point on COVID-19, some organizations just didn't want us in because they just didn't want to risk the chance of infection. but now we're seeing a little bit more. Some clients are asking us to be in, but some people are doing it remote as well. So I think that's probably more on an individual firm. I would say to you that if you don't get the answer you're looking for, then I would press the issue with that. I mean, there's from an auditor perspective, there's definitely advantages of being on site, as Allison mentioned. One of the difficulties on remote is trying to get a hold of a person. And again, I mean, we've done that by regularly scheduling, certain times of the day that we were going to talk, and we found that as a way of managing it. But again, I would say, you need to do what's right for your organization, and just work that out with your auditors. Conrad, one person asked if you could repeat the program-specific portion of the audit. There were some audio difficulties there, so.
Sure, no problem. So a program-specific audit can be available to you if you only have a single federal award or a single federal program or a single cluster, as long as it's not a research and development cluster. So as soon as you have more than one, this is no longer an option. But a program-specific audit is a really good option. You'd have to check your specific grant document to see if it prohibits a program-specific audit. And it would also be good to check with who's ever overseeing your program to make sure that they're okay with a program-specific audit versus a single audit. And all of the compliance requirements are the same regardless of whether it's a program audit or a single audit, but it does alleviate some of the additional work, and it does not require it to be paired with a financial statement audit. I hope that answers the question.
Again, I just a follow-up on Conrad said, talking with that oversight official is really important. It wasn't a program-specific audit, but Conrad and I recently worked on an organization doing it's not quite a agreed upon procedures, but I guess more of that with compliance and talking with the people at the State Department was really important in terms of, figuring things out, what was required and interpreting some of these compliance guidelines. So the question came up about how about an R&D award? Does it need pre-approval from the government agency before program-specific audit is allowed?
My understanding is that with R&D funding, program-specific audits are not allowed, but it's worth checking with your agency. But everything I've seen and have been provided with says that R&D awards are excluded from being eligible for program-specific audits.
So these are a lot of good questions. Before I close it up here, are there any other questions either about, what the audit process is, any suggestions that you may have that you can share with the others as to what's made your audit gone successful, or if there's been a problem, what has the problem been? If there's anyone that wants to add anything on that, that's fine. We have a few more minutes left. And I'll just give everyone a few seconds to do that. If not, then I'll just give some closing comments and everyone can gain back a few minutes in the day, which is always important. So the question, I think, is for COVID funding. You said they don't have numbers yet.
CFDA numbers.
Yeah.
Yeah, so for ARPA specifically, there tend to not be separate CFDA numbers. It's essentially funding that has been injected into various other programs. If there is uncertainty about what program or what CFDA number the funding is for, the source for checking with that would be whoever's overseeing, whoever that program manager is for you on that program, and they should be able to provide that information. So we just wanted to point it out so that those questions do get asked in case there is a program or even a separate program that needs to be tracked under a specific CFDA number, or if a program that you do have has passed through funding from something like ARPA, because that would trigger compliance requirements under uniform guidance.
Okay, well, some really good questions. Now's the time, ask away. If not, I guess thank you for joining us today. Our goal today was to help shape your thought process for planning and conducting the audit, ensuring that it goes as smoothly as possible and efficiently as possible. Hopefully we've had achieved that goal today, and you walk away with a few nuggets that will help you in this endeavor in the future. For more information about this or other thought leadership, please visit our website, which is listed on the following page. Or if you have any specific questions that you don't want to ask the group, please contact either Allison, Conrad, or myself. Our contact information can be found on our company website. Thank you for your time today, and have a good day. Bye.